$100 silver has attained much of the world. But here's what the institutions aren't showing you. 70 million ounces, gone, not moved, not reclassified, vanished. While central banks face legal subpoenas, while China pays double-digit premiums just to secure physical metal, while registered inventories collapse at the exact moment prices explode, the question isn't whether silver hit $100. The question is, what happens when the business community realizes their currency can no longer buy what 1 ounce used to cost? And more urgently, what happens when institutions with billions to deploy discover there's not enough metal left to fill the orders? Welcome to Currency Analyzer Now. If you've been in business long enough to remember when a $100 bill actually meant something, when it could fuel your operations, cover payroll, and still leave working capital, then you already know we don't live in that world anymore. This channel exists for those who recognize that shift and refuse to be caught holding devalued paper when the repricing arrives. So do me a favor. If you appreciate analysis that treats you like the experienced professional you are, not like someone who needs hype or entertainment, click that subscribe button right now. We don't chase trends here. We track capital flows, supply chains, and monetary reality. And before we go further, drop a comment and tell me, where in the world are you watching this from? Because what's happening to silver isn't happening in one country. It's happening everywhere. And I want to know if you're seeing it too. Now, let's get into what the institutions hope the business community ignores. The United States Department of Justice served grand jury subpoenas to the Federal Reserve, not quietly, not through back channels, publicly. And the chair of the central bank responded in front of cameras, framing the legal action as pressure tied to interest rate decisions. Within 48 hours, gold and silver markets began moving in ways that veteran traders recognized immediately. This wasn't speculation, this was repositioning, because when the institution that controls the world's reserve currency faces the possibility of criminal investigation, markets don't debate the details. They ask one question: can monetary policy still be trusted? And when that question enters the room, confidence begins leaking out of bonds, out of currency markets, and into assets that cannot be printed. Silver closed the week in the low 90s per ounce. Gold settled near $4,500. Those aren't just numbers on a screen. They're statements about what a currency unit can no longer purchase. When a single ounce of silver requires nearly $100, the metal isn't expensive, the money is small. Now, this isn't the first time markets have seen metals rise. But this move carries a signature that separates it from ordinary volatility. The price action is multiple standard deviations above historical norms. The gold to silver ratio has compressed into the low 50s, meaning silver is outperforming gold. And that compression signals something critical. The market is no longer just seeking safety, it's pricing scarcity. Gold typically leads when fear drives demand. Silver leads when the move broadens, when industrial reality collides with monetary distrust, when the world realizes a metal is both needed and finite. Right now, silver is leading. And that should concern anyone in the business community holding large cash positions. Because leadership changes in metal markets don't happen by accident. They happen when supply constraints meet surging demand. They happen when the physical world calls the paper world's bluff. Analysts on financial television have begun using phrases like once in a generation and secular trade. They're accidentally telling the truth, because monetary regime shifts don't arrive on schedules. They emerge when structural imbalances reach breaking points. And the structural imbalance here is simple. The world has underinvested in mining capacity for over a decade, while simultaneously increasing industrial dependency on silver for technology, energy systems, and electronics. Here's what business leaders need to understand. You cannot print your way out of a supply deficit. You cannot stimulate a mine into existence. You cannot issue a press release and summon metal from the ground. Production timelines for new mines range from 7 to 15 years. That means even if capital flooded into exploration today, the supply response wouldn't arrive until the early 2030s. In the meantime, the market has only one tool to ration demand: price. And price is doing exactly what it must. It's rising. Now, some will argue this is speculative excess, that retail enthusiasm has pushed prices beyond reason, that a correction is inevitable. And volatility is indeed inevitable, but volatility within a structural uptrend is not the same as a trend reversal. Pullbacks shake out weak positioning. They transfer metal from impatient hands to patient capital. They do not eliminate the underlying drivers, and the underlying drivers remain firmly intact. Trust in central banking is deteriorating. Political pressure on monetary policy is intensifying. Industrial demand for silver continues regardless of investment sentiment. Supply remains constrained. Inventories are falling, not rising. That combination doesn't resolve with a single down week. It resolves when price climbs high enough to either destroy demand or unlock new supply. Neither is happening yet. So the question facing the business community is not whether silver will pull back. The question is whether the pullback represents opportunity or whether waiting for perfection means missing the repricing entirely. Because here's what most people misunderstand about regime changes. Historical ceilings become new floors. The levels that held for decades get breached. And once breached, they don't return. This is why silver approaching $100 matters. Not because the number is round, but because it forces a psychological reset. Once the market accepts that $100 barely buys an ounce, the conversation shifts. Business leaders stop asking, is silver expensive? They start asking, what will $100 buy next year? And that question, once it spreads, becomes contagious. Right now, the early positioning is happening quietly. Institutional allocators are beginning to evaluate hard assets, not as crisis hedges, but as baseline portfolio requirements. Sovereign wealth funds are watching. Pension managers are watching. Corporate treasuries are watching. They're not buying yet, but they're watching. And when institutions of that scale decide to enter, they don't accumulate gradually. They establish positions. And when positions are established in markets with limited physical supply, price doesn't drift higher, it gaps. That's the setup. Legal pressure on the central bank, metals breaking out to multi-year highs, physical markets tightening globally, and institutions beginning to recognize that the old playbook no longer applies. The question is simple. Do business leaders position before institutional flows arrive? Or do they wait until the narrative is consensus and the easy entry point is gone? There's a number that should terrify anyone in the business community paying attention, 70 million ounces. That's how much registered silver, the kind companies can actually take delivery of, has vanished from major Western vault systems in recent months, not moved to another category, not reclassified, gone. And here's what makes that number devastating. Registered inventory is the metal that backs the paper market. It's the physical substance that gives futures contracts credibility. It's the reserve that allows exchanges to function without breaking. When that reserve shrinks by tens of millions of ounces while prices are rising, it means someone is converting paper exposure into physical metal, and they're doing it aggressively. Now, most business leaders never think about vault categories. They see a price on a screen and assume that price represents available metal. But the architecture of the silver market operates on two levels. There's the paper level, where contracts trade electronically, where leverage is standard, where positions can be opened and closed without a single ounce changing hands. And then there's the physical level, where metal must be found, allocated, transported, and delivered. Those two levels are supposed to stay connected, but right now they're diverging. And the place that divergence shows up first is in premiums. Premiums are the price businesses pay above the official spot price to actually get metal in their possession. When premiums are low, it means the physical market is calm, supply is adequate, delivery is smooth. But when premiums spike, especially when they spike in multiple regions simultaneously, it means the physical market is under stress, and that's exactly what's happening. China has been paying double-digit percentage premiums over international spot prices, not occasionally, persistently. At times, the premium has exceeded 10%. Think about what that means for a moment. A market willing to pay 10% more just to secure physical delivery is a market that does not trust paper promises. It's a market that believes metal in hand is worth more than a contract. And here's the twist. Even while paying those premiums, Chinese inventories have been falling. Visible stockpiles in the Shanghai Futures Exchange system are now below 40 million ounces, so the largest industrial economy in the world is paying premium prices and still draining inventory. That's not a temporary imbalance, that's a structural deficit playing out in real time. Now, shift attention to the supply side. The world has systematically underinvested in mining capacity for over a decade. Between 2010 and 2025, exploration budgets for silver mining contracted by more than 40%. Why? Because the price signal wasn't strong enough to justify the risk. Because capital markets rewarded share buybacks, not long-term resource development. Because the business model of mining became increasingly difficult as ore grades declined, environmental regulations tightened, and political risks in mining jurisdictions increased. But during that same period, industrial dependency on silver increased dramatically. Solar panel manufacturing alone has become a structural consumer of hundreds of millions of ounces annually. Electronics, medical devices, water purification systems, 5G infrastructure, all require silver. And unlike investment demand, which can pause during corrections, industrial demand doesn't stop. Factories don't shut down because metal prices rise. They pay the higher price. Pass it to consumers where possible, and absorb margin compression where they cannot. Here's the mathematical problem. Business leaders must understand production timelines for new silver mines range from 7 to 15 years. From initial discovery through permitting, financing, construction, and ramp up to full production. That means even if capital flooded into silver exploration today, The supply response wouldn't arrive until the early 2030s. And capital isn't flooding in, it's cautiously observing. Because mining companies learned a painful lesson in previous commodity cycles. Committing billions to long-term projects during price spikes often means coming online just as prices collapse. So they wait. They demand sustained price signals. They require proof that demand is structural, not speculative. And while they wait, the deficit widens. In the meantime, the market has only one mechanism to balance supply and demand: price. Price must rise high enough to either destroy marginal demand or make previously uneconomic deposits viable. Neither threshold has been reached yet. Industrial users cannot substitute away from silver in most critical applications, and previously uneconomic deposits still require years of development even after becoming economically attractive. This is why the current price move is different from past volatility. Past moves were driven by investment sentiment, which could reverse quickly. This move is being driven by a supply-demand imbalance that cannot be resolved quickly. The world built a decade of underinvestment into the system. It simultaneously built a decade of rising industrial dependency into the system. And now, as investment demand layers on top of industrial consumption, the system is discovering it doesn't have enough metal. Business leaders watching this unfold need to understand a critical distinction. Volatility within a structural uptrend is not the same as a trend reversal. Pullbacks will happen, sharp ones. But pullbacks in a supply-constrained market don't eliminate the underlying problem. They simply transfer metal from weak hands to strong hands, from speculators to long-term holders, from those who need liquidity to those who need the asset. And each time that transfer happens, the base of support rises, because metal that moves into strong hands doesn't come back to market easily. It gets held, allocated, removed from the available supply pool. This is the architecture business leaders are navigating now, a paper market built on leverage and speculation, sitting on top of a physical market experiencing genuine scarcity. A supply response that cannot arrive for years, meeting demand that's accelerating now, and a price discovery mechanism that's only beginning to reflect the structural reality beneath the surface. The question isn't whether this creates opportunity. The question is whether business leaders recognize the opportunity before the rest of the market does. Now shift attention to India. Over the past few months, Indian silver investment vehicles have absorbed more than 50 million ounces. In one single month, inflows exceeded 20 million ounces. To put that in perspective, that's nearly half of what some entire countries hold in strategic reserves. And this isn't speculative trading, this is allocation. Indian investors, many of whom have cultural and generational experience with precious metals, are moving capital into silver at a pace that suggests they see something the West is still debating. They see currency risk. They see inflation that official statistics underreport. They see a metal that holds value when paper does not, and they're acting on it. Here's what makes Indian demand particularly significant. These aren't retail speculators chasing momentum. These are multi-generational family businesses, professional investors, and structured investment vehicles making deliberate allocation decisions, the kind of capital that doesn't exit on the first pullback, the kind of capital that treats precious metals as foundational portfolio holdings, not tactical trades. And the pace of absorption is accelerating, not slowing. Now, combine those two demand centers, China draining inventory while paying premiums, India absorbing tens of millions of ounces through structured vehicles, and ask a simple question: where's the metal coming from? Because global mine production hasn't increased, recycling flows haven't surged, and Western inventories, as already established, are falling. So when Eastern markets are absorbing this volume, someone in the West is supplying it, either willingly or unwillingly, either through deliberate sales or through forced delivery against paper contracts. And here's the critical insight business leaders must understand: this transfer isn't reversible in the short term. Metal that moves east doesn't typically flow back west during price corrections. Cultural attitudes toward precious metals in Asia treat them as permanent wealth stores, not trading vehicles. Families that buy gold and silver in India and China don't sell when prices rise 10 or 20%. They add on dips. They accumulate over decades. They pass holdings to the next generation. This means every ounce that flows east effectively leaves the Western available supply pool permanently. It becomes locked away in private vaults, temple holdings, family reserves, and the Western market, built on the assumption that metal would remain available for lease, rehypothecation, and paper contract settlement, is slowly discovering that assumption no longer holds. Now, while Eastern buyers have been acting decisively, Western institutions have been watching, sovereign wealth funds are evaluating, pension managers are conducting research, corporate treasuries are running scenarios they haven't entered yet, but they're no longer dismissing hard assets as crisis hedges for conspiracy theorists. They're beginning to model them as baseline portfolio requirements. And that shift from skepticism to serious consideration represents a fundamental change in institutional thinking. For decades, the institutional playbook treated precious metals as a small percentage allocation, 5% or less, held primarily for tail risk protection. The thinking went, most of the time, metals underperform. But when everything breaks, they protect capital. That framework is changing. Institutions are beginning to ask different questions. What if currency debasement isn't a tail risk, but a baseline scenario? What if the underperformance of metals over the past decade wasn't because they're poor investments, but because monetary policy artificially suppressed them? What if the correlation structures that worked for 40 years are breaking, and hard assets need to be core holdings, not satellite positions? These questions don't lead to 5% allocations. They lead to 15, 20, even 25% allocations. And here's the problem. When institutions of scale decide to move, they don't accumulate gradually. They establish positions. A sovereign wealth fund managing $200 billion that decides to move 5% into precious metals, that's $10 billion. A pension system managing $1 trillion that moves 3%, that's $30 billion. Now, think about the physical silver market. Total above-ground investment-grade silver inventory globally is estimated somewhere between 2 and 3 billion ounces. At current prices, that's roughly $200 to $300 billion of total physical supply. Sounds like a lot, until you realize that's the entire global stock, not the amount available for sale. Most of that metal is held by long-term investors who have no intention of selling. It's in private vaults, sovereign reserves, industrial stockpiles, religious institutions. The amount actually available for institutional purchase at any given time is a fraction of that total, maybe 20%, maybe less. So when Western institutions managing tens of trillions collectively begin trying to establish even modest percentage positions in physical silver, there isn't enough available supply to accommodate them without massive price disruption. This is the setup that sophisticated allocators are beginning to recognize. Eastern buyers removing supply from the market permanently, Western inventories falling, industrial demand rising structurally, and institutional capital still sitting on the sidelines, watching, analyzing, preparing. The question facing business leaders isn't whether institutions will enter. The question is, what happens to price when they do? Because when large capital tries to enter small markets, price doesn't drift higher gradually. It gaps. It moves violently. It leaves those waiting for perfect entry points behind. And right now, while institutions are still in the observation phase, while they're still running models and conducting due diligence, the window for early positioning remains open. But that window is closing. Not because of speculation, not because of retail enthusiasm, but because the physical supply simply isn't there to absorb institutional scale demand at anywhere near current prices. The business leaders who understand this dynamic, who recognize that being 3 months early is better than being 3 days late, are positioning now, quietly, without fanfare, without waiting for consensus. Because they know that by the time the institutional narrative becomes consensus, by the time financial media is celebrating the move, by the time allocators who were skeptical 6 months ago are suddenly believers, the easy entry point will be gone. Now, let's address what all of this means for business leaders making capital allocation decisions today. There's a fundamental distinction that separates successful investors from those who consistently miss major moves. It's not intelligence. It's not access to information. It's the ability to distinguish between trading volatility and positioning for regime change. Trading volatility means trying to capture short-term price movements, buying dips, selling rallies, managing risk through tight stop losses. It's a perfectly valid approach for traders with the time, skill, and temperament to execute it consistently. But positioning for regime change requires a different framework entirely. It requires recognizing when the underlying architecture of a market is breaking, when the rules that governed price discovery for decades no longer apply, when structural imbalances have grown so severe that resolution requires repricing, not reversion to the mean. And right now, the silver market is exhibiting every characteristic of a regime change in progress. Legal pressure on central banks that control reserve currencies, physical inventories vanishing while prices rise, Eastern buyers paying premiums and still draining supply, Western institutions moving from skepticism to serious evaluation, production timelines measured in years while demand accelerates in months. These aren't temporary dislocations. These are structural breaks. And business leaders who treat structural breaks as trading opportunities, who wait for pullbacks to get a better price, often discover that the pullback never comes back to their target level. Or worse, the pullback does come, they hesitate, and the next leg higher leaves them behind permanently. Here's the critical question every business leader must answer honestly. What is the actual downside of being early versus the downside of being late? If a business allocates capital to physical silver today, and the market pulls back 15 or 20% over the next few months, what happens? The position shows an unrealized loss, uncomfortable. but not catastrophic. The metal is still there. The structural drivers haven't changed. The early position simply waits for the market to catch up. Now, consider the alternative scenario. A business leader waits for confirmation, waits for the perfect entry, waits for institutions to validate the thesis. And while waiting, Eastern buyers continue removing supply, registered inventories continue falling, and then institutional flows actually arrive. Suddenly, the metal that was available at $90 per ounce is trading at $130, then $150, then higher. And the business leader who was waiting for an entry at $80, who wanted to be smart about timing, now faces a choice: chase the move at much higher prices or abandon the position entirely. That's the asymmetry business leaders must weigh. The cost of being early is temporary discomfort and unrealized losses. The cost of being late is permanent, because once institutional flows reprice a small market, the opportunity to establish positions at reasonable levels doesn't return. Now, let's address the portfolio construction question directly. How should business leaders think about hard asset allocation in this environment? The traditional framework suggested 5% or less in precious metals, a small hedge, a tail risk buffer, something to own just in case. But that framework was built during an era when central banks had credibility, when currency debasement was gradual and managed, and when commodity markets were deep and liquid. That era is ending. Central banks are facing legal subpoenas. Currency debasement is accelerating. Commodity markets are discovering they're not nearly as liquid as financial models assumed. In this environment, 5% in hard assets isn't prudent diversification. It's symbolic. Business leaders operating in industries with commodity exposure, with international supply chains, with significant cash holdings, need to think differently. 15%, 20%, perhaps more. Not because precious metals will outperform equities every year, but because when currency credibility breaks, when commodity scarcity meets monetary distrust, the assets that preserve purchasing power become more valuable than the assets that generate nominal returns. A business that generates 20% annual returns in nominal terms, but operates in a currency losing 15% of its purchasing power annually, is only generating 5% real returns. And if that business holds its working capital, its reserves, its strategic cushion entirely in that depreciating currency, it's systematically destroying real wealth even while reporting nominal profits. This is the conversation business leaders aren't having. They're focused on revenue growth, market share, operational efficiency. All important, but none of it matters if the unit of account they're measuring success in is collapsing. Silver, gold, hard assets generally aren't investments in the traditional sense. They're insurance against monetary instability. And right now, the cost of that insurance is rising because the risk it protects against is materializing. So here's the framework business leaders should consider. Step 1, acknowledge that currency risk is real, not theoretical. Step 2, determine what percentage of capital cannot afford to lose purchasing power. Step 3, allocate that percentage to assets that preserve value when currencies don't. Step 4, hold those positions through volatility, because regime changes don't resolve quickly. And step 5, ignore the noise. Ignore the analysts who call every 10% pullback a top. Ignore the commentators who insist metals are in a bubble. Ignore the instinct to trade in and out. Because the business leaders who successfully navigate regime changes aren't the ones who trade perfectly. They're the ones who recognize the change early, position appropriately, and hold through the transition. Right now, the transition is underway. Legal pressure on central banks. Inventories vanishing. Eastern buyers acting while Western institutions watch. Supply responses years away while demand accelerates now. The setup is complete. The only question remaining is whether business leaders position before institutional consensus arrives, or whether they wait for confirmation and accept significantly higher entry prices. That choice, made today, will determine whether businesses preserve purchasing power through what's coming, or whether they discover too late that the currency they trusted no longer buys what it used to. The regime is changing. The question isn't whether to adapt. The question is whether to adapt early or late. And in markets where physical supply is limited, early and late often means the difference between establishing a position and watching from the sidelines as the opportunity disappears.